The financial services industry generates hundreds of billions of dollars in fees every year. A significant portion of that comes from people who aren't entirely sure what they're paying for, whether their advisor is actually working in their interest, or whether they even need an advisor in the first place. This video is going to give you an honest, balanced look at financial advisors, what they do, the different types and how they get paid, when they're genuinely worth it, when you're probably fine without one, and how to find a good one if you decide you need help. Let's get into it. First, let's clarify what financial advisor actually means, because the term is almost meaninglessly broad. In the United States, virtually anyone can call themselves a financial advisor. There's no universal license or standard. What matters is what specific credentials and legal obligations they have. There are three major categories. The first is a fiduciary advisor, someone who is legally required to act in your best interest, not just recommend something suitable. Fee-only fiduciaries are typically paid by you directly, not through commissions. They don't earn money from selling you products. The second category is a broker or broker-dealer representative, who is held only to a suitability standard. They just need to recommend something that's appropriate for you, not necessarily the best option. They're often paid by commissions, which can create conflicts of interest. The third is a hybrid, which is increasingly common, someone who acts as a fiduciary in some contexts but not others. How do advisors get paid? There are four main models. Fee only, you pay a flat fee, hourly rate, or percentage of assets under management, AUM, typically 0.5 to 1% annually. The advisor earns nothing from commissions. This model has the fewest conflicts of interest. Commission-based, the advisor earns commissions when you buy financial products, mutual funds, annuities, insurance policies. The incentive is to recommend products that generate higher commissions, which may or may not align with your best interest. Fee-based, a combination of fees and commissions, sounds like fee-only but isn't. Clarify exactly what you're paying and how. Assets under management, the advisor charges a percentage of the money they manage for you, typically 1% annually. On a $500,000 portfolio, that's $5,000 per year. This model aligns the advisor's interest with growing your portfolio, but the costs can be significant over decades. Let's talk about the AUM fee in more detail, because this is where people most often underestimate what they're paying. A 1% AUM fee sounds small. But consider, on a $500,000 portfolio growing at 7% annually over 20 years, the difference between 7% growth and 6% growth, after the 1% fee, is staggering. At 7%, $500,000 becomes about $1.93 million. At 6%, it becomes about $1.60 million. That 1% fee cost you roughly $330,000 over 20 years. This doesn't mean an AUM fee advisor is never worth it, but you need to be clear about what you're getting in return for that cost. So when is a financial advisor genuinely worth it? There are several scenarios where professional guidance provides real, measurable value. 1. Complex tax situations, business owners, people with equity compensation, those navigating large capital gains events, or anyone with multiple income streams and deductions to optimize. A good CPA advisor combination can save tens of thousands in taxes annually, easily justifying their fee. 2. Major life transitions, divorce, inheritance, a liquidity event from selling a business, sudden wealth, or a complex estate that needs planning. These are high-stakes moments where a mistake is very expensive. 3. Behavioral coaching. Studies consistently show that average investors underperform their own investments because they panic sell during downturns and chase returns during rallies. A good advisor who keeps you from making emotional decisions during volatility can preserve hundreds of thousands in returns over a career. 4. Comprehensive financial planning, retirement income strategy, Social Security optimization, Medicare planning, long-term care, estate planning. This is complex, and an advisor who specializes in this can deliver genuine value. When do you probably not need an advisor? If you have a relatively straightforward financial situation, you're employed, saving regularly, investing in diversified index funds through a 401k and Roth IRA, carrying no high-interest debt, and have basic estate documents, you likely do not need an ongoing paid advisor. The investment strategy for most people is genuinely simple. Invest in low-cost index funds across a diversified portfolio, maintain your allocation, don't panic, increase contributions over time. This is not a secret. You don't need to pay someone 1% annually to do this for you. The financial industry has a significant incentive to make you believe investing is more complicated than it is. Here's what the data says. A landmark Dalbar study found that the average equity fund investor earned roughly 3.6% annually over a 20-year period in which the S&P 500 returned 9.5%. The gap wasn't advisor fees, it was behavioral mistakes, buying high, selling low, chasing returns. Separately, research by Vanguard suggests a good advisor can add about 3% in net returns annually through behavioral coaching, tax-efficient investing, smart portfolio construction, and withdrawal strategies in retirement, primarily through behavioral value rather than market-beating stock picks. The question is whether you need someone to do that for you, or whether you have the discipline to do it yourself. If you decide you do want an advisor, here's how to find a good one. Start with NAPFA, the National Association of Personal Financial Advisors. This directory lists fee-only fiduciary advisors. Also check the Garrett Planning Network for advisors who work on an hourly or project basis, which is ideal if you only need help with specific questions rather than ongoing management. When you meet with a potential advisor, ask these questions directly. Are you a fiduciary at all times? How are you compensated? Do you receive any commissions or referral fees? What services do you provide, and what's your investment philosophy? Ask for a sample client financial plan and ADV Part 2 disclosure form. This legally required document outlines their fees, services, and any conflicts of interest. Any advisor worth working with will answer these questions clearly and completely. Consider alternatives to full-service ongoing advisors. A one-time comprehensive financial plan from a fee-only planner can cost $2,000 to $5,000 and give you a roadmap for the next decade without ongoing fees. Many CFPs, certified financial planners, offer hourly consulting. You pay for the specific questions you have and nothing more. Robo-advisors like Betterment and Wealthfront provide automated portfolio management at 0.25% annually, far less than traditional AUM advisors, with built-in tax loss harvesting and rebalancing. For people who want some human guidance, hybrid services like Vanguard Personal Advisor Services offer access to CFPs at 0.3% annually, which is a significant discount from traditional 1% models. Let me give you a practical framework. If you're under 40 with a straightforward situation, you probably don't need an ongoing advisor. A one-time plan or occasional hourly consultation is likely sufficient. If you're approaching retirement or have a complex situation, a fee-only fiduciary CFP is likely worth the cost. If you want automated portfolio management, a robo-advisor at 0.25% is an excellent option. And regardless of whether you work with an advisor or not, always understand exactly what you own, what you're paying in total fees, and whether your portfolio strategy is consistent with your actual goals and risk tolerance. Financial advisors can be incredibly valuable, but only if you know what you're buying and why. Subscribe for more content like this, and I'll see you in the next video.